My guest today is Lead Analyst Logan Mohtashami to talk about the existing home sales report we got and also mortgage rates. Logan, welcome back to the podcast.
It is wonderful. We're actually both in Dallas right now. You're about I think 5 minutes away from me.
Yeah, you're stuck in a hotel room, but I'm in the office, so that's very nice since I live here.
The life of the chart daddy, always in a hotel room, right?
It's so true. Okay, well, we have so much to talk about. First off, let's get to existing home sales, which we're recording this on Thursday morning, came in pretty strong.
Well, here's the thing. A few months ago, I made it a mantra of mine that the reports for June to October, in the months that will be coming out on July to November, are going to have some of the lowest year-over-year comps in the history of America. So if we see year-over-year growth, you take it with a grain of salt because you're working from the lowest bar ever in history. And I think what happened is that because rates were elevated and they stayed elevated early in the year, a lot of people thought sales were going to decline noticeably. And that wasn't the case in any of the data lines. So now mortgage rates have actually gone lower. We've had the best 8 weeks of purchase application data, but that's not part of this existing home sales report. That's something that could happen in the future. But because the bar is so low, we've had back-to-back months of year-over-year growth. A few other months before this, the data was flat. So flat year-over-year growth and higher year-over-year growth. It's just a very low bar of sales. So I think if people were shocked because they saw the new home sales report come in and that, beat estimates. And we talked about that yesterday. But here it's just a very low bar. We really shouldn't read too much into it. But again, this is all with elevated rates. Now that rates have come lower, it takes about 30 to 90 days for purchase apps to filter into the existing home sales report. And we've seen some of the structural shifts in the housing market starting in mid-June. So it is what it is. It's exactly what we thought it would be, and we saw slight year-over-year growth in our weekly tracker. So just take that for what it is. That even with elevated rates, we're still able to get a little bit of growth. Now it's a little bit different now that we're under 6.64% on mortgage rates.
So, and purchase apps came in 7 weeks of positive data, or is it 8?
The last 8 weeks, 7 have been positive, 1 negative, double-digit year-over-year growth every time. It's the best 8 weeks of the year, where previously we always had year-over-year growth, but the week-to-week data was choppy. Like 1 week would be up, the other week would be down, flat. Now we have consistent scaled growth on the week-to-week data, which is very positive. That's what we saw last year. That caught some people by surprise. And last year, of course, bond yields went lower and then they shot right back up. Here, we don't have that aggressive reversal, but we never actually got as low as we were last year on the 10-year yield. It got down to 3.62%. It broke the Hodor line, which it should have never done, but it did.
That's so helpful. Yeah, so we should see, I think it's interesting and good to note that this current growth is not from the last 7 weeks of positive data, because that's going to take a while. So we should see that when in November, December.
Usually it takes 12 to 14 weeks of positive weekly purchase application data to hit the existing home sales lines. And again, it's just a little bit of growth from a very low bar. But in any case, the longer you stay near 6%, the better it is for housing. Okay. And we've had a little bit of a retracement recently. So we'll see how that impacts the data. But so far, considering what everything has gone on this year, I'm very happy because inventory is able to grow. Price growth has been able to cool down. Now, price growth, if I use the NAR's median sales price, which I never use, and pretty much like every month is higher than my forecast this year. And we saw year-over-year growth in prices again. And now the supply and demand equilibrium has shifted the last 2 months in our data line. But the NAR's total inventory probably has already peaked. The peak this year was about 1.55 million. It was down just a little bit. Monthly supply didn't really move much here. So it's basically just, kind of getting a little bit of growth toward the end of the year. We'll see how the rest of the year holds up, especially if rates could just stay near 6%.
Yes. Okay, so let's talk about rates, the 10-year yield, and what's happening in the larger economy that's affecting that. What is going on?
It has been a very, very positive year. A positive day for economic data. Jobless claims went all the way back down to the low 200,000, where it really regresses to. Continuing claims is down just a little bit. Remember, the labor market is softening, but it's not breaking. Breaking is when jobless claims shoot up to 323,000 on the 4-week moving average. So that hasn't been the case. The GDP was revised higher. The consumption data a little bit better. That's a little bit backwards looking. Durable goods was fine. So it was a very positive day for economic data. I think the last time I checked, the 10-year yield was like 418, 419. So good on the economic front. And again, because mortgage spreads are better this year, rates haven't made a very aggressive move higher off of this week's 10-year yield move.
Let's talk about the jobless claims, right? This was the shocker last month. I mean, the jobs reports over the last couple of months have been a thing that's like, okay, something's really happening here. So explain to me why jobless claims came in better than expected and what that means for the last couple of months.
So 1.5 to 2 million people lose their jobs every single month. But if the economy is really going into the recession, growth really slows down and consumption starts to slow down. So that 1.5 to 2 million people we lose, you tend to get more people fired, less job growth. That's how you get negative jobs data. Job growth has slowed down to the lowest levels of this century, really, without a recession. But the jobless claims data has not laid off. And why do we say this? We've always made this the main point. If you're thinking recession, you're going to need jobless claims just to get up to 323,000 on the 4-week move average. The Federal Reserve has written stuff about this, that they look at 400,000 as their negative breakthrough. But if you get up toward there, you got something. So far, we have never been able to even get to that area because we're still growing enough with the economy to where we don't need massive layoffs yet. Now, if the credit market's broke or your consumption starts to fall, that's different. So this is the difference between a labor market getting softer and job growth getting softer, where manufacturing jobs are being lost, construction workers are being, if it really wasn't for AI, like total construction labor would be down noticeably, because it's not just the data centers, but electrical grids, stuff like that is really holding the construction up. But softening and breaking are two different things. This is why we always wanted to make sure to let people know, don't go into that discussion, because there's a lot of crazy theories on the internet still about this, but this has always been the number one thing. You can't have a recession unless jobless claims break. That's why in 2022 we made that the mantra. So claims just came back down to the lower levels, and the labor market is still intact. When rates get down to 6%, things get better for housing. The builders might be able to wind down some of that supply where they could feel comfortable pushing housing permits. And this is something we saw last year as well. Economic data was getting weaker, and then all of a sudden it reversed, and that reverse led yields higher. But now it's a much different backdrop. Job growth has slowed down much more this year than last year. The risks to the economy are much higher, but the 10-year yield is more stable this year than it was last year.
So we do have a variable coming up, which is the shutdown of the government, and this time Trump has said that they won't just furlough people, that they will actually, people will lose their jobs. Of course, that's already been happening, right? Since Doge came in, lots of jobs have been lost in DC, have not really seen it in the numbers. Do you feel like when you think about a shutdown, is there a time limit on that before it starts to make a difference? Not just in jobs.
Generally speaking, a government shutdown is not going to be like the end of the world, but every week it goes on, it just becomes a less prolific economy in terms of getting things done. I think like FHA lending, can it even continue without government, stuff like that. This has all been just the worst circus for like 13, 14 years of this whole government shutdown. This is why they should just, the debt ceiling and all that stuff, just get it away so we don't have to worry about any kind of maneuvering around a government shutdown. But, it's one of the more tragic offsets of this whole political movement, where I think we just don't get along as well as we used to. And this always happens. But It is part of society. I never believed like the government shutdown is going to destroy the American economy or everything. I mean, listen, we've laid off a lot of federal workers, and the labor market is still holding up because it's a small sliver of the total workforce. But you can't have a properly functioning, economy in terms of getting stuff done that needs government workers there. So more of a nuisance. But if it prolongs itself longer and longer, it becomes more problematic. So we see these things always. They either get a deal or this is very short out there. But
So you addressed what it could mean for jobless claims, and you're like, it doesn't have that big of an impact. But as far as mortgage rates, is there any part of that that affects the 10-year yield and mortgage rates?
in theory, you get a little bit of a hit the longer it stays in there. But I mean, I've always thought this is like a summer camp circus. This whole government shutdown thing. So I don't think of it as a big thing because I don't believe it stays longer and longer. But we did have one time where the government was shut down for a longer period than people thought, and one of the greatest heroes in American history, Mr. Bridge Loan Man himself, came on TV and told Americans, if you can't buy groceries, get a bridge loan with your, or something to get you. And then Trump had to like get the government back on because that was such a, terrible take on
I
people.
don't remember this. Who is Mr. Bridgeloan?
Wilbur Ross. You remember Wilbur Ross, the guy who has
Oh
a
yeah,
tomato can?
yeah.
Yeah, so one of the greatest unsung heroes, Wilbur came on TV and said, get a bridge load. I'm like, oh my God, homie really said bridge load. Oh Lord, this thing's over with. We all knew it was over. We all knew the shutdown was over when Wilbur said, get a bridge loan to buy your groceries or something like that. I was like, man, y'all can't say that kind of stuff on TV because it's going to look so
Not a good look.
disconnected. But it worked. Wilbur Ross got the government back working again because of his statement. So uh, wherever you are, Wilbur, bless your heart.
What else are you looking at this week? This will come out on Friday. So what other data is there to look at right now?
I just think that the housing data just firmed up a little bit as rates go down. That's how you should look at it. The new home sales number will probably get revised a little bit lower, but one of the things I've tried to show people is if you look at purchase application data for new homes, it was showing that growth was going to happen. It might not be 800,000. But growth is there. Existing home sales, that growth, should have been expected. It was part of our weekly contract data for some time now. I think it's good for people to see how we were always talking about. We're showing slight year-over-year growth, and don't kind of make too much of a deal of it, but it should be here, and here it is. And the comps are going to get a little bit harder past October, so that year-over-year growth will need a lot more sales to get there. But at least now people get to see how the tracker works, how the 10-year yield, how the labor market, how the whole economic enchilada works itself with the rates and housing and everything in that. So it pretty much looks kind of in line what we've been saying. Slight year-over-year growth. Market dynamics shifted with rates getting under 6.64%. We'll see how we could close the year out.
Amazing. Logan, thanks for being on from every hotel room in America. We really appreciate it, even if the lighting's a little crazy and you're, we ask a lot of you. So
I know I made an AI video. I brought Pennywise coming behind me, from the CNBC interview. So, it's funny. Everybody talks about Chat GPT. I've never used Chat GPT. People go, how do you use Chat? I said, I don't ever use it. I just look at charts and just, there it is.
you are really good. Your AI game on social is amazing. So
It's more for marketing than getting information.
All right. Well, Logan, thank you so much. We'll talk again soon.